the lesson today and talk about our trades because Kevin is coaching a soccer game for his daughter. So, and I was actually pretty excited. So last week's commentary, Kevin was talking about mistakes that people make when trading options. And so I got really excited about that topic because that's what I do. that's where my expertise comes into play, and so that's why I was excited to teach this lesson and continue that conversation. So the first question I want to ask, and if you want to type in, if you know an answer, go ahead and type it into the questions box here. What is the most important factor when selecting an option to trade? And James, I know you know this one because James and I go way back, so, and he's got the right answer. I'm going to see if a few more of you have the right answer. What is the most important factor when you're selecting an option to trade? I'll give you a hint. It involves the most basic economic law. Abraham says luck. Yeah, yes, in a way. So that goes into a totally different topic because I read a journal article that talks about they actually did study to find if luck was real, and it is, but it's not what you think it is. So it's a factor, but it's not the most important factor. So James so far is the only one that has it right, and the answer is price, right? And so I'm going to scroll this down. Now I can show you the top here. The value of an option or the price of an option is the most important statistical factor in making a decision when purchasing or selling, when buying or selling an option. And the most basic economic law that we all know, I know everybody's heard this, is to buy low, sell high. It doesn't have to be in that order. You can start by selling high and then buy low later. But if you sell high and then buy even higher, that doesn't work from an economic standpoint, right? If you buy low and then sell even lower, that doesn't work from an economic standpoint. So it's a simple math. It's the most basic economic law. You have to buy low and sell high. Now, why is this so difficult with options trading? I love the fact that there are options out there that have become so popular, and there's a whole bunch of people out there that think that they can get their education off the internet for free, that they can get AI to tell them something or do it for them. They don't really understand option pricing at all. And because they don't understand option pricing at all, they think, oh, I learned a call option is what you buy when you think a stock price is going to go up, so I'm just going to buy a call. So they buy the call, the stock goes up, and they lose money. Well, why? Because they paid way too much for the option. It was ridiculously priced. And last week when Kevin was talking about mistakes that people make, so this is the most common mistake people make when they're trading options. They pay too much. They're not accurately valuing the options and purchasing them at a good price. So how do we do that? So I'm going to talk about the factors. So there's a whole bunch of factors that affect the stock's price, or an option's price. The stock price is one of them. The higher the stock price is, more likely the higher the value of the option is going to be. The amount of time that you're purchasing. So when you buy an option, you're purchasing time, correct? You've got a legal contract. An option is a legal contract that says if I buy the option, I buy a call option, that gives me the right to purchase shares at the strike price anytime before the expiration date. And so the longer that expiration date is, the bigger the risk is for the person who's selling the option. And that means the the more expensive that option is going to be. So the amount of time that you have on your option price is a factor. And this is the big one that really messes with people, that they don't know how to value options, and that's volatility and uncertainty. So whenever you purchase an option, you have to make a guess at what the price range is going to be in the near future. And so my great mentor and great friend Don Fishback has this software that's really cool. And I think I've already talked about this at least once, but some of you may not have heard it, but you can interchange the word volatility and probability. The volatility is a measure, it's a statistical measure that we can get probability out of. So they kind of go hand in hand. You can't have one without the other. So you have to make some kind of an estimate on the probable outcome of the trade in order to accurately price the options. And people do this, and some people don't know how to do this at all, and those are the guys out there that are paying way too much for options. And we love that those guys are out there, because that's how we get great options. But I wanted to show you this little app that Don Fishback has, because it has this bell curve right here. And I'm sure you guys have been exposed to a bell curve before. But what is a bell curve? All probable outcomes lie in a bell curve. And you probably heard the rule that says 2/3 of all outcomes lie between plus or minus 1 standard deviation. Well, that's where we get this bell curve. So if we get 1 standard deviation down is right about here. Let me draw on there. 1 standard deviation down is right about there. 1 standard deviation up is right about there. So 2/3 of all outcomes should lie in this area right here. And so using this information, we can actually draw on charts and do all kinds of stuff to say what are the most probable outcomes for this asset going forward. So what this app is doing that's unique, that is something that I use that's really important, is we have the Black-Scholes model, which actually it won the Nobel Prize for its creators, at least those that were living at the time that it was awarded. It got them the Nobel Prize for bringing order to the options markets, because pricing before they modeled this was kind of all over the place. But the assumption that is, there's a few assumptions, and one of the things that was said, it was Fisher Black who said, it's surprising that this thing's still around when it's based on at least 7 unrealistic assumptions. Well, one of those assumptions is that the future price of the stock is going to land in this bell curve, and the bell curve is based on a log normal distribution. And so that's the expectation. So whenever someone's pricing an option, or whenever people are looking at stuff, they have all kinds of models. This Black-Scholes model is not the only one, but they all make this assumption that the log normal returns of the price changes are going to fall within this bell curve. So what Don Fishback did is this histogram, this dark histogram here in the background, is showing how the stock's price, and in this case, I've set it to go back 4 years. How was the stock's price actually distributed over those 4 years? And this one actually takes earnings into consideration, because we've got earnings coming up here on Micron this week. And so it's looking at how the stock prices actually behaved. And we can see that the modeled price, this green line, is different than the actual distribution of the stock over the past 4 years. And so if the stock is going to behave, if our expectation is that the stock is going to behave the same way that it has over the previous 4 years, and it's going to do that again going forward, in whatever strike price or whatever expiration date we choose, if we're saying that what it did over the last 4 years, it's going to just keep doing that, it's going to do it again. So you kind of learn that stocks have their own individual personality. So what this is saying is that this data came from Friday. So this is a little bit, and this is just for expiration on the 20th. So this next Friday. is the expiration date. And you can see here the ask price of a put is 23.20, and this was on Friday. And this is at the money option, so the 425 where the stock closed, right around 425. So this is the at the money option, the asking price for a put. So if you just came in and said, hey, I need protection for this earnings announcement, something that expires the week after earnings, I need to buy an option to protect my position, and you just plop down 23.20, you pay too much for the option, because if the stock continues to behave the way that it has over the past 4 years, it should be priced. The fair price is 1671. And so what is a fair price? So a fair price is that if the distribution is maintained, then the expectation of profit is 0. So to explain that in terms that we can all understand, let's pretend we're flipping coins, okay? And me and Stuart, we're gonna play a game. We flip a coin, and every time Stuart calls the right answer on the coin toss, he gets $1, and every time he chooses wrong, I get $1. So we play this game. We flip coins all day long. What is the amount that we expect to walk away with at the end of the day? Anybody have a guess? Just 50-50 bet on a coin toss. We flip coins all day. Every time I win, I get $1. Every time I lose $1. How much am I going to walk away with at the end of the day? Exactly. James has heard this, and Russ got it too. The exact price is 0. We're going to walk away with the same amount of money that we started with, because it's a fair game. It's a fair game, and that's what this fair price is right here. So if we want to get an advantage, if we want to buy an option that has some kind of an advantage in this situation, we need to pay something. And this is why this software is so good for me, that I love. I need to pay something less than 671 to give me a positive earnings expectation. Okay, so when we have people that are out there and we start to worry, we get in this bearish market mode where we're like, I got to protect my assets, I got to buy puts, I think the market's going down, and people are just shelling out money and they're shelling out crazy amounts of money for options that are ridiculously priced. What is that? That's a $7, almost a $7 premium above the fair price for that option. So that's pretty hard to overcome. That's really hard to overcome. And that if you just think of that disadvantage right there, we got to do something different, right? I need protection, but I got to do something different. Well, how can what's the strategy that I'm going to use if this is the price right here? Oh, that was terrible. Undo. Yeah, if 23.20 is the price for that put, how can I get it at a cost? How can I buy that protection at a cost that's less than 1671? I could put in a limit order and just hope and pray. That might work, but probably not. If we're talking in terms of probably not going to work. So we have to choose a strategy, right? We have to choose a strategy where we can get some way of reducing costs. And you guys I'm pretty sure most of you have heard our collar strategy, and that's exactly what we're doing with collar strategy. Is we're going to find some other dummy to pay for the cost that's unfair here. We're going to let some other person pay for that. And how do we do that? We sell a call. We sell a call that's out of the money at a price that we're willing to accept, right? We go maybe out a longer time period, to get that money, but we would sell it and let somebody else pay for the insurance on our position. Because if the puts are expensive, so are the calls, guaranteed. Because volatility and probability have, there's no directional value in those numbers. It doesn't tell you that the stock is likely to go up or down. It's just, yeah, everything that comes out of volatility and probability is just telling us what we can expect for the size of a move in the future. It's not telling us anything about which way it's going to go. It's just telling us that those options are pricing in a bigger move than something that we expect, right? So when I say that, I'm saying I'm expecting that the price distribution of this asset, because this asset, and this is Micron, this asset has a personality. It has a range. It has a range of prices. The people trading it have personality, and the people trading it have decided that this stock moves something that's a little bit bigger than what the model suggests. And so for me to get some kind of advantage, I need to actually, I shouldn't say that it moves bigger than the model suggests. It's saying that the stock doesn't move as big as the model is suggesting. These options are expensive. It's saying that more often than not, the moves are stay inside of one standard deviation more frequently than they should according to the model. And when we see prices that come out here like this that are outlier moves that happen out here, then we would see maybe in this spot the moves are low like this, and we get to big outliers down this side of the chart. That would tell us the options are cheap. But in this case, these options are not cheap, they're expensive. And so we have to use a strategy that is going to, in this case, we're going to let some other dummy pay for our expensive options so that we get protected the way that we want to be. But we figured a way to let somebody else pay for the exorbitant cost of these options to buy protection that we need. And so that's what I wanted to just talk about. So pricing options and valuing options it's a science, but there are so many players out there that completely ignore, and if you just think about people when they panic, the analogy, and I'm sorry, James, that you have to hear this again, but the analogy Don used to always use is buying insurance, right? And options are just like insurance. If you've got insurance, fire insurance on your house, or maybe you don't have fire insurance on your house, and your kitchen lights on fire, your wife's cooking dinner, or you're cooking dinner, and there's a grease fire in the pan, and it lights on the cupboard, and you start to get scared, and you forget you didn't buy fire insurance, and so you quickly run outside and you call the fire department first. But then as soon as you call the fire department, you get off with them and you call your insurance broker and say, hey, I need to buy fire insurance on my house. And the guy says, well, what's all your urgency? And you're like, well, my house is on fire. He's like, all right, well, you wanna buy insurance and your house is already on fire? And you say, yes. Do you want to know how much it's going to cost? And you say, I don't care. That's a panic, right? I don't care how much it's going to cost. All right, I'll let you have it. And they let you have it, right? They stick it to, and then the fire department gets there and they take care of your house, and the damage is minimal, and you really didn't need the insurance at that price. And then you call back and you say, hey, can I cancel that policy now? I'm not going to need it. And then he says, sure, you can cancel it now, but you've already paid the premium, so you already lost money. And that's what we're doing differently, is we're thinking about things ahead of time to know exactly what we need for protection, to know what we want to have it, and we're only willing to pay a price that's reasonable something that works in our favor. It's hopefully it's unreasonable. We don't mind paying unreasonable prices when it's lower than 1671. If it's unreasonable to the person selling it, we don't mind being on the opposite side of that trade. But this is what you got to think about when you're purchasing options. You can't just say, oh, I'm bearish, I need to buy a put, and expect that it's going to work out well. Because if you're paying too much for the options, the probability of it turning out well for you is not good. It's not good at all. So you really have to think about that, okay? And if any of you want to talk to me about this kind of stuff, I can talk for hours. Right, James? James knows. I can talk for hours on this topic. And valuing options. It's really important that you know the value of your options well, so that you know when you're paying too much or you're paying too little. If you're accurately valuing options, then you enter trades only when those prices are advantageous to you. All right, so we got earnings coming up this week on Dollar Tree, Lululemon, DocuSign. The big one for us is on Micron on Wednesday. A lot of you have Micron positions. And by the way, Micron, let me show you, I want to talk about some of these charts. So this is, I just pulled up the charts for this year, and you can see Dow Jones Industrial Average, it's down pretty good. NASDAQ Composite is down. It's not as steep as Dow Jones Industrial Average. S&P 500 is also down, not necessarily as steep as the Dow. And volatility, I hope you guys have heard the name. The other name for the volatility index is the fear gauge. It measures uncertainty and fear. So it's something that we definitely need to pay attention to. And volatility's been high, and so this tells you right away that most likely when you're looking at the options that on the stocks that you're following, when VIX is moving up like this, the chances are that that stock that you're looking at or the one that you own has expensive options more likely than cheap options. And I was going to pull up Micron. Let's look here. So Micron for this year has actually been pretty darn good. So that's been a big winner. If I had a spreadsheet on here, a lot of our core holdings. So you can see as at the close today, S&P 500 is down 2.6%, Dow's down 2.4%, NASDAQ Composite down 4.72%. And the stocks that these are all kind of core holdings that we've got in our positions that some of you have. Some of you might not have all of these, and because each person we're getting in at different times when money's available, and we treat everything different. But man, that Micron is stand out right there. It's up 49%. It's almost 50% up this year so far, and that's been a big one. In fact, if you just sum up all of these and figure out the gain, we're slightly positive with that Micron if you have all of these positions. If you didn't do any option trading and you just had the stock, that's what this is showing right here. You're still positive 0.67% when the market's down substantially higher than that. Now that's not necessarily how each of your accounts are looking. You have to go to your own accounts to look at what your own values are. To decide that, because option trading and everything else will make stuff in there turn out a little bit differently. But I just wanted to give everybody a quick update on just how things are going right now. So well, let's kill that, close. I'll just do that. All right. Let me get back to my Word doc. All right, so briefing.com. So this is what's been causing all the volatility, the war in Iran. It's easy to say. War in Iran is driving oil prices up. It's oil prices help move transport everything. The risks in the market are that price of oil going up will be inflationary to everything else because we have low supply, high demand. That's going to make prices of everything go up. So there's a briefing.com article here you can read if you would like to. It's just showing the crude oil prices. When's this going to be over? It could be soon. It could be soon. Some of the things that are going on are, saying they've I heard that some boats have been some tankers have actually been moving around in the Hormuz Canal. So that's a positive thing. If they open up that Hormuz Canal, that opens things up again. And I think that might be one of the things, because that information got out to the market, and that might be one of the things that's causing the market to bounce higher today. We've also got a Fed meeting coming up this week, and that Fed meeting, is got it to the point. So we've got this news that says, oh, maybe the war is going to be short, like Trump was saying, it'll be short. Maybe it will be short. Where's our market going to end this week? We're still bearish on everything. I kind of hope that we'll get, because I want to cash out some puts and buy some more shares. So I kind of hope the market keeps going down, and we can cash out on some of that protection that we've got and use it to buy more shares of stock. So when it does rebound, it'll rebound to the upside really good. We've got retail sales came out today, industrial production, housing market. None of that was really a factor in the market today. Tomorrow we'll get housing starts and permits, pending home sales. Wednesday during the day, earlier in the day, we'll get mortgage applications, PPI, petroleum status report. That might be important with petroleum status. But the big thing that so we're expecting that the market's going to kind of go into wait and see mode. Wait till they hear what Chairman Powell says in the press conference. So there's usually an initial reaction when the announcement comes out at 2 o'clock, but it doesn't mean anything until you hear what the Fed chair says, because it won't be what happened in the past. Isn't what drives the market. It's what they expect from the future. So my expectation personally is that the Fed chair is not going to lower interest rates at this or the Fed chair, that the whole Fed committee is not going to lower rates this particular meeting. I suspect that we won't see another rate drop until after a new Fed chair is put in, which will happen sometime soon. But we'll see how that happens. But everybody's waiting to see what he says at that conference, and so we're always looking for opportunities. We're watching the market every day so that you don't have to. And we're always looking for opportunities. But we'll see what happens. Jobless claims on Thursday. Until this happens, everything's going to be kind of wait and see. There could be war news, things like, that are unexpected, that are not on this schedule for economic reports, that could drive something in the market over the next couple of days. We'll see. But right now the market's kind of in a wait and see what the Fed chair says on Wednesday. And it's likely that we'll be kind of flat until then. Jobless claims on Thursday, new home sales, business inventories, natural gas report. Those things will be things that could move the market. Then we got quadruple witching on Friday, and Jerome Powell will speak again. And usually when he speaks after the fact, he doesn't really reveal anything new. He just might reveal information that helps justify the position that the committee made when he speaks after. So he'll be speaking on Friday. The market still holds its breath anytime the chair is speaking, so they hang on every word he says because he can move the market with his words for sure. How are we looking to trade? We've got protection. We're still heavy in cash. We're still waiting for the market to decide what it's going to do. We're still kind of trading flat to bearish. I kind of hope it goes really bearish before it goes back up. So we'll see how that turns out. We'd like to get some money out of those protective puts that we have on, and I think most of the positions we've been we're covered probably on both sides, but it might be at least on one side we'll have a covered call where we can take some profits off the covered call if it doesn't move aggressively. As time goes and volatility expectations drop, then the costs get lower, and that helps us to endure some short moves and down moves as well. So any questions from anyone any questions about anything? Let's see. Yes, I've seen a few different articles that was talking about, James is mentioning that there's a lot of shorts in place on the US dollar. Yeah, exactly. Come on down, 20%. Yep, 20%, maybe more. We'll see. We'll see how it goes. While you guys are thinking of questions and typing them in, a couple of things I saw. Hedge funds are aggressively shorting financial stocks because and Kevin was talking about this last week. It's a difficult position right now to trade because of the uncertainty. The uncertainty in the market is just really high. So we don't think the AI is gone. We don't think that the major players are done and that the bubble's being burst or anything like that. It's just people don't know where the uncertainty is really revolving around the war, gas prices, how governments are going to handle it, all that kind of stuff. And people are shorting financial stocks. Yeah, exactly like you say. Yeah, yep. There's a lot of financial things going on where people are just trying to position themselves for what might happen in the future. We'll see. Treasury's volatility gauge, 9-month high on the war effect. So this is exactly what you're talking about, James. Exactly what you're talking about. The yields on treasuries are expected to decline, and their interest, that's they're inflationary. So oil prices rising is inflationary to stocks. And it's funny because I just want you to think about this a little bit. So inflation, when things inflate, it's not necessarily a bad thing for the stock market. Everybody feels like, oh, inflation is just bad for the stock market. Well, it's actually not bad for the stock market. When inflation is high, everything inflates, including stock prices. So everything inflates, including stock prices. So inflation is actually good for the stock market until the Fed starts fighting it. So when the Fed starts raising interest rates, and that's why everyone's paying attention to whatever the Fed chair says. If he said something, and this is my expectation, if he says, I don't think he's going to say this on Wednesday, but if he said, you know, our next rate change will probably be higher to raise rates rather than lower rates. If he said that, people are going to start to panic real quick, and we would see. I would expect we would see the market drop. I don't think he's going to say anything like that. In fact, the whole point of talking to people is to try to keep them calm. The Fed does not like big volatile moves based on what the Fed says. They just try to keep everybody updated ahead of time so that they know they're able to likely guess what the Fed's going to say, so that they can react ahead of time. And we don't have giant moves. But if he does surprise us, if he says something surprising, we could see it either way. He could, if he lowered rates, it could be off to the market. If he says, you know what, yeah, there's war going on, there's inflation, but we're going to help the people out there that need lower gas prices. We're going to lower interest rates. If they say something like that, it could go, you know, I don't think he's going to say anything exactly like that, but if he did, we could be off to the races on the other side. So, and we could see the market heading up. But so it's, and this is the cool thing about our strategy. I don't have to be right on which direction the market's going to go. I'm hoping that it goes down right now because we've got a whole bunch of protective puts on our holdings, and I want to cash those out so we can buy more shares at a low cost. But we'll see what happens when the Fed chair speaks, and we'll keep positions on that are going to be advantageous to us regardless of which way the market does move. We just need a big move. We don't like this sideways movement that we've had recently. We want the market to move, to choose a direction and start heading that way. And that's, once we get more of that, then it'll be a little bit easier for us to trade. But right now we're just playing this game of for the market to make a move. All right, any other questions? All right, I will let you guys get going, and we will see you back here next week. And it'll likely be Kevin again next week, but we'll see you then. And I just hope you keep at it, keep watching. Just know you're safe. You're all right. All right. We'll talk to you guys later. See ya. Bye bye.